Hi, this is Jim Cunningham, and we're going to talk about oil and gas investing, a tax mitigation strategy. So, for about 100 years, the United States has followed a policy to encourage people to domestically produce oil and gas. So, this is something that a lot of people really, I think, don't know enough about. It's a great tax deferral strategy, meaning you don't pay taxes now, you pay them later, and then when they do come back in, you're paying those at a lower rate because you get what's called a depletion allowance. So the two big things: tax deferral. It is an investment. You are not only getting your investment back, but also a return on your investment. Ideally. And then there is also the income that comes in. You're taxed at a lower rate due to depletion. So you basically get a 15% discount on your taxes. So a lot of people, again, aren't aware of the tax benefits of investing in oil and gas. So the United States is the largest oil producer in the world. That's not always been the case. It was for a while, then it wasn't. And so this is part national security. It's part energy security. And it's why the government really encourages Americans to invest in oil and gas. And so we're going to look at this. This is a really effective strategy for W-2 earners. For those of you who might have seen our solar video, and if you haven't, I would really encourage you to take a look at that. There's also federal subsidies and federal encouragement to invest in green and renewable energy, which sounds totally opposite from the oil strategy that we're talking about. It's really a yes and, because we need both for a healthy economy. And this is really good for the W-2 earner. So if you're someone who's earning a paycheck and you've got a lot of income coming in, you say, I this mortgage interest deduction just isn't working enough for me. I'm maxing out my 401k. What else can I do? What sort of weapon can I have against the government to keep them from taking half my paycheck? Well, this is one of those, right? So it's a tax deferral strategy and also a tax reduction strategy as well. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I have over 30 years experience as a lawyer practicing in estate planning, and I'm a certified specialist in estate planning, trust, and probate law, a real estate broker, securities, and insurance licensed. I'm also a pilot, and I'm not current, but a pilot when I was flying. So these are the lawyers at our firm. For those of you who watch our videos, we have added recently to our head count. So we are growing and we're able to help out more people, in large part, I think, to the credit of these videos that if you're watching. So Christina will be joining us here in a moment, and her partners are Alyssa Kroger and Shannon Behan. And Christina and Alyssa and Shannon are all certified financial planners. And this is very important, which means they are fiduciaries. And what a fiduciary means is that fiduciary has to put the interest of the client, right, which is not them, put the interest of the client before the person who is working with them on the financial advisory side. And this is very important. All guarantees are backed up by the claims paying ability of the issuer. All these are hypothetical examples, and you should always consult with your financial professional before regarding your individual circumstances. And this is a very important disclosure. You should read this. We're going to give you a little bit of time to read this. These are securities, and they're offered through Cambridge Investment Research. And this content is really for general information only. And here's the legal disclosure, which is we're going to talk about a lot of stuff. This is not legal advice. So if I say you and I'm looking at the camera and you're watching this on YouTube or listening to it, there's no attorney-client relationship just by watching the video. So very important. Don't watch this and go out and do a bunch of stuff. So we do have a picture here, if you're watching this, of what are we talking about here? Well, we're talking about the drilling of oil. Now, for many people, they say, well, gee, is this kind of like the movie There Will Be Blood? Are people trying to, like, where is the oil? Are they trying to find it? Well, no, they know where it is. I mean, this is 2024. The areas of operation primarily that we'll be talking about are the Permian Basin and the Anadarko Basin. So these are, Texas is a huge oil producer. They've got a lot of areas that where they're producing oil in, but this is coming from the United States and primarily from Texas and a little bit from Oklahoma, as well as New Mexico. And so the way it typically works is you have a property owner that signs a lease to the oil company. They tie up the land. The oil company typically knows that there's oil there, or they kind of know where everything is. And then what they do is they have the lease, and then they start production, and they take investor money, and they pump out oil, and they take their portion, and the investors get their portion. So what we're talking about here is investing in oil and gas, investing in a company that then turns around and produces oil from areas where it's pretty well known where the oil is. So looking at where our oil price is going. So where oil price is going here, kind of for the remainder of the year. And if you're watching this, happen to be watching this in 2025, which is the future, you will know what happened. But right now we're in April of 2024, and we're kind of looking at where we think oil prices are going to be in the future. And what you see here is oil prices are trending upward throughout the year. And we have Christina Lindsay joining us now. Thank you, Christina. Welcome.
Yes.
And so what we've been talking about is oil in Texas and in the Permian Basin and some other areas. A lot of this oil is already, people know where the oil is, right? They understand where it is. The question is, what is the price of oil and what is the cost of extraction? And if those numbers add up, there's a return. So I'll let you take it away here on where the pricing's going.
Yeah. So in the Permian Basin, in most of the West Texas Permian Basin, and that's going to be Midland, Odessa, Carlsbad, Hobbs, New Mexico, and a little bit of Oklahoma. But most of that Permian Basin, that is old salt beds. So it's very brackish. There's no potable water that they can contaminate. It's proven reserves. And so that is a market where to your point, they know geologically they have not drilled a dry hole for many of these major companies. I mean, I'm not talking about those that are out wildcatting and that don't do this professionally, but those that are really big companies that we choose to work with, they've not drilled a dry hole since 2009. They're able to go into proven reserves. They're able to go many layers deep into the shale, directionally drilling, but they're doing it in an old salt bed. So it's in a very like I said, not an environmental concern when they're directionally drilling or hydraulic fracturing because of the reserves that they're going into.
Yeah, my aunt Christina, I think you know this. My late uncle founded a company that was an oil services company, and they do a lot of work in these areas. And they live in Fort Worth. My aunt does, and my parents moved there a few years ago. So I have kind of family familiarity with this, and it really is not like the movies where, and I mentioned earlier on, There Will Be Blood, where they're going out and they're not sure where it is. Nothing like that. I mean, there's
No.
so much knowledge, geologic knowledge. The question is, what's the price of oil? What's the cost
Yeah.
of extraction? And how efficiently do you do it? And you get a return. Not only do you get a return, ideally, not only do you get a return of your investment, the money you put in, but also a return above that. And I did mention that when it does come back, it's coming back with a depletion allowance. So what that means is, if you get $1 in return, what happens is you're not taxed at $1. You're taxed as if it's 85 cents. So 15% of that goes tax free, and that's very, very important.
Right. And as far as the cost goes, most of the current producers are cash flow positive at $55 a barrel. I mean, they can still cash flow at $35 a barrel, maybe $40 a barrel with inflation. At that price, they might consider capping the well. But as long as we're north of 55, we're in the cash flow positive territory. And so, oil prices are back on the rise. I think that we're kind of in this, again, range bound era where we're going to stay probably in this $75 to $85 barrel range for quite some time is the expectation.
Well, let's look at rig counts. I mean, what we're talking here is how many are out there producing oil.
Yep. So we're definitely seeing a higher rig count. We are seeing some consolidation in the industry that took place largely due to COVID, is the large producers that already had a presence in the market that could maintain cost efficiencies when oil prices did fall negative during COVID for that temporary period of time. But the rig counts are back up. And so we're seeing continued increase in production domestically. We're not seeing that slow down by any means. So as far as, reduced production, not really a concern right now.
And primarily, this is going to be in Texas and a little bit in Oklahoma and a little bit in New Mexico,
Yeah, a
not
large
not in other
degree.
states. So not in California, not in Pennsylvania, not those other areas.
Yep, a large degree in Carlsbad, Hobbs, New Mexico, which raises the question that I think we get all the time is what about regulation?
Yeah.
What about politics? And it's interesting because both sides of the aisle, we're a nation dependent on oil, plain and simply. So even as we make strides in the global presence as far as renewables, we're a leader in the United States for renewable energy. I think we're 12 to 15% renewables, depending on which source you are looking at. But as far as electric vehicles, I think that we've seen that that's not something that is going to be adopted as widely further than what we've currently had the adoption rate. It's probably going to be more hybrid. So as far as electric vehicles, still being under 10%, I think we're just above 5% as far as adoption rate on electric vehicles. There's still high demand for oil. And New Mexico is a very purple to blue state neighboring the Texas very red state. And those two dominant industries that support their economic well-being, as well as supporting the teachers unions, supporting the fire department, supporting all of the resources, it comes from oil. So there is, as much as politics can have a lot of headlines and catchy phrases, there is a demand to work together. And in both New Mexico and in Texas, they're very pro the oil industry. And so they know that too many jobs, too much of their employment market, too much of their tax revenue is dependent on these industries. And so even whether it's been, under the Obama era, under the Trump era, under the current Biden era, a lot of these people in the energy commissions, they're working together. So this is not something where we're seeing a lot of hindrance in that particular market, as much as headlines would disagree.
I like this one. For those of you watching this, it shows a frozen wind turbine in an electric car. I drive a Tesla, so this is kind of me. And Christina, you and I have done a road trip in the Tesla and had to stop um, at some pretty interesting places to get a charge. Let me just put it that way. But this is real. So renewables in so we're in California. A lot of California's energy comes from solar and wind. I mean, it's a fact, right? A lot of it comes from renewable, but the wind doesn't blow at night, and obviously the sun is there at night. It's just the Earth is turned around, right? And we're not getting that sun exposure, and we do need that energy. I charge my car at night. So I charge my car after midnight when it's cheaper, and that is coming likely from probably natural gas, if I had to guess, in California. So probably natural gas fired generator. So very, very important. Even as we do shift largely to renewables, we
Mhm.
still do need oil and gas for energy, and also plastics and just general medical. There's a whole litany of products. Fertilizer. A lot of people don't realize fertilizer comes from oil, so it's a
A
big.
lot of natural gas production. Yeah. Even as we've had our electric vehicle and renewables adoption rate go higher, our demand for oil has also gone higher, both domestically and globally. So it's not a replacement, it's a in addition to. And oil is used in so many different things, everything from deodorant, petroleum. I mean, it's in so many different iPhones. So it's not going away. Newborn oil is highlighted here. Many of you know that we've had Newborn Oil on in the past as one of their executives. And we've worked with them for about a decade now. And so they're one of a couple of different producers that we work with. So there's two different producers really that out of the privates in the industry, they have a strong presence when you compare them with the big names. And they're typically selling to those end users such as Royal Dutch Shell, Exxon, Chevron. And it's not that Exxon, as you can see here, Exxon and Chevron, it's actually not so much that they're reducing their amount of oil purchasing. It's just that they're not operating as much. And so as there's been this ESG movement towards some of the publicly traded companies, and if you look at Exxon and Chevron, they're up there as two of the top rated 5-star ESG rated companies by Morningstar. And it's not because of their oil exposure, but they're definitely not operating as much. They're purchasing more. So they are doing everything in an environmentally friendly way. They are working on more renewables. They are expanding and diversifying their energy sector. However, they're still purchasing as much, but they're purchasing from the private producers like a Meborn or like, some of the other private producers that are out there, US Energy, some of the others. So this is kind of deceiving in a sense that they're not reducing their acquisitions. They're just not actively operating as much.
Let's talk about environmental considerations. I think this gets, we're in California. We get a lot of, uh, there certainly is not as much oil being produced in California as there could be. And I think largely due to environmental considerations, people don't want, they don't want to produce the oil here. It'd rather be produced in Texas or Russia or Iran or Saudi Arabia and shipped. And I'll just say, I'm in the Bay Area a lot. My wife and I have a home there, and we can see out into the San Francisco Bay, and we see the oil tankers come in, and they're coming in 24/7, and they're pumping their oil out in near San Rafael in Point Richmond there, and pumping the oil, and then it goes in and gets refined and then goes into the cars and industry in California. So just because you may not see oil being produced in California doesn't mean that it's not being brought into an extremely environmentally sensitive area, which is the San Francisco Bay. Now it is they're doing everything they can to keep it safe. But the environmental considerations are very important, not only on the production, but how it gets to us. So maybe talk about the well design and air quality, and water. I think is really important. A lot of people are concerned that with oil production, it's contaminating groundwater or causing other problems. But maybe walk us through this, Christina.
Yeah, and it's interesting. You just brought up, production in California. It's after being shut down since COVID, basically. Exxon is just opening up all their production on their tankers in Santa Barbara, off the coast in Santa Barbara and Ventura. So, and Exxon is the single largest funder of the school districts, and in Santa Barbara, Ventura County, they're one of the top 10 funders. So even though it is something that's not done to a wide degree in California, they're actually turning on those wells and reproducing again. As far as the environmental concerns, I found this probably most fascinating when I went down to actually go boots on the ground in the Permian Basin. And especially after seeing some of the movies and the Hollywood productions, and those are largely based on the Appalachian and the Pennsylvania area that had not had regulations that has existed. They had zero regulation. They had brand new production, didn't know what to do with it. They were definitely not environmentally friendly or safe, and they definitely had issues. But in Texas, they've had regulations surrounding this and how to do this environmentally safe for over a century. And so when we went down to the Permian Basin and actually watched them drill, the way that they're drilling is if you were to look at like a little bigger than a 12-inch radius, it's probably about 18 inches, 12 to 18 inches radius of what is a pipe that is drilling down into the Permian Basin. And that, again, salt water, not potable contamination whatsoever, no drinking water. And that big pipe is then the drill. And then what they do is once they've got to where they want to get to the reserves, they then put another smaller drill that's maybe 4 inches in diameter, 3 inches in diameter, and they do perforation in between it, and they put cement between that 4-inch barrier and that 12-inch to 18-inch barrier. They're putting cement that's quick, so that if anything were to get out of that 4-inch barrier, it's going to hit the cement wall. But then again, they're drilling through maybe like a 2-inch, 3-inch diameter from what was originally this 12 to 18-inch pipe that went down, and there's concrete barriers and all kinds of things to make sure that there's no contamination with anything in the earth. Then as they're pulling it out, because they're pulling out oil, gas, water, a lot of salt water. And so what they've done to even become more environmentally friendly, and some of the producers save about $2 a barrel just by trucking that water and doing desalination and recycling that water for other uses. And so they've actually become, with all the modern technology with desal, they've been able to really get efficient with how do we use these resources to do even greater things. And so that's what they're doing in those areas.
So let's kind of get into the cost. So what is it? So if I invest, I put some money into an oil and gas investment, what happens to the money? Like where do the funds go?
So, um, it's going towards the drilling of new wells and new reserves. And again, these are proven reserves, so they know where they are. And as you're drilling a new well, about 70% of that is going to be intangible costs, and 30% is going to be tangible. That's kind of the average range. And so a couple of the different programs that we work with, there's kind of two general different structures. One is to provide a huge intangible drilling cost deduction in year one, and that can range between typically 85 to 90%. And that's going to be a year one deduction. That's deductible off your highest taxed income first. So ordinary W-2 business income, and that's going to be deductible at both state and federal level. And so that's going to be the intangible IDC, what we call the IDC deduction. The intangible drilling cost deduction has existed in the tax code for a very, very, very long time. And again, despite headlines, this is something that's existed for a long time. Both parties have benefited from, both representatives on both sides of the aisle and their districts have benefited from. So this is not something that we see a threat to going away. It's been around, like I said, for a long time. And then income classification, meaning the royalty income, if you will, the production of that finished product as they're selling off the oil reserves to the Exxons of the world, the Chevrons, the Royal Dutch, the big companies, the end users. As that income stream comes back into the investors, 85% of that is taxable. There's a 15% what we call depletion allowance because it is a depleting resource. And most of these income streams, from the time of investment to the life cycle of the well production, you're looking at about a 12 to 15 year income stream.
So this is interesting. So if I am, we have a lot of clients who are high W-2 earners and business owners as well, but we get a lot of people with high W-2. A lot of people, maybe they have stock options through the company they work for. And a lot of times these are same day exercise. You got to pay a lot of income tax. And it's just kind of, it's a real bummer to pay. Honestly, it's a real bummer to keep paying that tax year over year over year. So what we're talking about is maybe you take some savings that you have, right? And invest that in oil and gas. And what that does is that gives you a corresponding income tax deduction that reduces your income for this year. So it's very important. So if you have some money in savings and you invest in oil and gas, your W-2 check goes up, right? So your deductions are going up and you can keep more of your paycheck by moving this money from one bucket to another. So moving it from like your savings account to an oil and gas investment, that reduces the amount of tax you pay. And when that investment returns to you, this is really important, is when that comes back, 15% of that is tax-free, 85% is taxable. So that's a depletion allowance. So all things being equal, if you put money in and got it back, you'd be ahead because you're paying 15% less in tax.
Well, and I had mentioned, we're not talking about any particular products here because this is a very unique investment. It is very specific. You have to be accredited to invest. It has to be suitable for you. So there's a lot of criteria. This is not an investment for everybody. And we're certainly not going to talk about any investment specifics with any specific companies. But generally, there are two structures. There are some companies that have a large deduction in the first year, and then you're getting an income stream for probably 12 to 15 years. And then there is another company that is doing a deduction over 2 years because they don't get all of their wells drilled in that first year. It might take a good 12 to 18 months for each year's investment portfolio to get all the wells fully operating. So they spread their IDC deduction over 2 years. So in year one, it's about 15 to 20%. And in year two, you're going to get the remainder to be about a total of 80 to 82% is the total deduction. But again, the bulk of that being in year two. So I was just speaking with a client of mine earlier this morning, and she's expecting to have a significant increase in income next year. and due to RSUs and all different kinds of additional compensation. And so we decided to invest a little bit more in the structure that is going to give her a greater deduction next year. So if you know you've got particular income challenges, whether it be this year or next year, we can look at doing a little bit of each structure. We can cater to what is really most suitable for you. But there is about the one that gets about a 90% deduction in year one, that has a little bit lower cash on cash returns initially because they're front loading the tax deduction. And then the one that has a tax deduction over the course of 2 years has a little bit higher cash on cash returns historically. So obviously that's not a guarantee of what future production will be, but a lot of these do have audited track records. A lot of these do have past performance that we can look at. Is your concern more upfront tax deduction, lower cash on cash returns? Are you okay with both? But this is something that could be very beneficial where you don't have to be a business owner. It works great for people that have high RMDs that we're looking, those are taxed as ordinary income. So you've got all this tax deferred income now coming out to you, kicking off ordinary income tax. So these are a lot of different situations that we'll look at. People that have NUA, people that have different RSUs, stock options. Those are all different reasons to look at how this could be a fit for you.
Yeah, and I want to mention, I just want to touch on net unrealized appreciation. And I think a lot of people number one, don't know about it. So if you have a 401k and you have company stock in your 401k, it's taxed differently than other stock in your 401k. So Christina, maybe you can talk about why somebody might want to pump the brakes before they just jump into an IRA rollover from their 401k, maybe help unpack that.
Yeah, it's a really good point. It's I'd say as far as examples of big companies, it's not as common, I would say, with newer high tech companies. It's certainly, in the world of RSUs in the Silicon Valley and the Bay Area, it's not as common. But I will say that there are a lot of people that have been employed with an employer for over 15, 20 years. And some of the big employers, they never changed their structure. So a couple that come to mind would be Chevron, Exxon, Northrop Grumman, where they actually had company stock inside the 401k. And if you think about it, when money comes out of a 401k, that's taxed at ordinary income. So if you're in California and you're in the highest tax bracket between state and federal, you're looking at about 53% tax. And if you were to look at pulling that stock out of the 401k, you only pay ordinary income on the basis. So let's just say you have Northrop Grumman stock at $10 a share. It's worth $100 a share. I'm just using simple math. If you pull that out of the 401k, you're only going to pay ordinary income on the $10 per share. And then that $90 gain is immediately treated as long-term capital gain. And you can let it sit there for as long as you want. But whenever you sell those shares, you're only paying tax on the $90 gain, and it's at long-term capital gain rates. So it's maybe 35% if you're in the highest bracket, but and if you move to a different state, you're maybe looking at 15 to 20%.
And it might be zero, because if your income's low enough, you're not paying any tax. So this is really, really important, I would say, for the people who are retiring from these legacy companies. You mentioned Chevron and Exxon, and we see that because Chevron's headquarters is San Ramon.
Mhm.
And we do see people with a significant amount of company stock in their 401k. Really pay attention to that, because I think less sophisticated financial advisors, and I do see this, they'll just say, "Oh, roll over your IRA, and we'll take care of everything," and you lose that if you roll it over.
There's very specific rules surrounding that, and that's really where. And there's also a sweet spot. We've done that with clients where they might have, a spreadsheet of 100 different lots of stock, where we might do it for certain lots and not for others. But that's really where we get into detailed analysis with our clients. So there's all kinds of ways to look at oil and gas as a potential part of your tax mitigating strategies. And these are just some examples of how we'll use oil and gas to offset the tax.
Now, if you're watching this on YouTube, please subscribe to our YouTube channel. And these this is being recorded, will be released on YouTube. And if you're watching it on YouTube, it's already happened. And go ahead and click the subscribe button. Our firm has offices in Northern and Southern California. throughout the state of California. And this is the contact information for Ascent Wealth Management. 805-312-7200 is our main number. We have a whole bunch of numbers, but the important one is 866-988-3956. And next week, we will have estate planning for college students and high school graduates. So when those kids who are 17 turn 18, it's a whole new world, right? And you're not going to have access to the health information. You may be paying their college tuition and all their living expenses, but they don't have to share any information with you. So I know when my children, who are now adults, went to school, my wife was like, "You got to be kidding me! You mean we can't look at their grades, but we're paying? Just wait, Christina. You'll get there one day." Again, go ahead and subscribe to our YouTube channel, and we will open it up for questions. And if you're watching this on YouTube, thank you for watching. Keep watching. Another video will magically roll after this one.